All right, let's go ahead and get started. Welcome everyone to this month's First Wednesday Tax Update. My name is Bruce McGovern. I'm a faculty member at South Texas College of Law, Houston, and this webcast is a part of a series of monthly webcasts that is an initiative of the State Bar of Texas Tax Section. And each month on the first Wednesday of the month, we take a look at recent developments in federal income taxation. Now, you should have received the outline and slides that go along with today's presentation. Those were distributed earlier today to those who have registered as of early this morning. If you don't have the outline and slides, you will be able to get a hold of them. And specifically, you can get them at these links. So the outline you can get at https://tinyurl.com/outline0220. And the slides are available at a similar link, just with the ending slides 0220. Now the outline that I prepare with two co-authors. They are Professor Cass Brewer at the Georgia State University College of Law in Atlanta, and also Professor Jim Delaney at the University of Wyoming School of Law. Now, today we are going to be taking a look at primarily some legislation from December of 2019, and that is called the Further Consolidated Appropriations Act of 2020. So we'll focus largely on that with perhaps one or two items that are outside the legislation that we'll consider. In the outline that you have, we have a summary of provisions in the legislation that my co-authors and I thought were most significant. So it's not a comprehensive analysis of the legislation, but they are the provisions in the legislation that we thought would be of interest to most people. Now, let's go ahead and begin taking a look through the outline. And what I'd like to do is first to, up front, talk about some disaster-related tax provisions that are in the Further Consolidated Appropriations Act. And I'll deal with these up front. I'm not going to go into a great level of detail about them, but I would like people to be aware that these provisions are there. The legislative provisions that we have are very similar to, or in fact identical to, legislation that Congress enacted in late 2017 in response to Hurricane Harvey, Hurricane Maria, and Hurricane Irma. And so if you recall those provisions, these will all be very familiar to you. What Congress has done is it has tried to fill a gap in the coverage of the legislation. So in late 2017, Congress enacted legislation, again, in response to Hurricanes Harvey, Irma, and Maria. Then in the Consolidated Appropriation, or actually Bipartisan Budget Act of 2018, it enacted legislation with similar provisions for the California wildfires, but there really has been nothing further since early 2018. And we've had a number of federally declared disasters since then, of course. So what this legislation does is fill that gap and make the provisions that we're going to discuss applicable to federally declared disaster areas from, say, that have occurred since the areas that were covered by the Bipartisan Budget Act. So that is where these, or why Congress has enacted these provisions. Now, I should mention, by the way, that I think most people should be familiar with this, but there is a chat feature which is built into the program that we're using. And the chat feature, of course, allows you to ask questions. And so you should find that at the top or the bottom of your screen, depending on the device that you're using. And I encourage you as you go along to ask questions about these provisions, and I'll do my best to answer those. Now, first we have, this is on page 4 in the outline, Page 4, it is item 4. And this is a credit that is available to employers who pay wages to employees during periods that the employer is inoperable in a federally declared disaster area. This is a 40% employee retention credit. So the concept is if the employer nevertheless paid wages to employees during a period when it was inoperable because of a federally declared disaster, it is eligible for this tax credit. And that's 40% of wages paid during the period the employer was inoperable. The maximum amount of wages that you can take into account is $6,000, so the maximum credit is therefore $2,400. And this becomes part of the general business credit for that employer. Again, Congress enacted the same provision in response to Hurricane Harvey. Second, and this is on page 6 of the outline, we see that Congress in this legislation has enacted a provision that makes it easier for those in areas affected by federally declared disasters to get access to their retirement funds in a few ways. First, Congress has permitted penalty-free withdrawals of up to $100,000 for those in areas affected by federally declared disasters. And specifically, recall if you remove money from a qualified retirement plan prior to age 59 and a half, you normally have a 10% penalty. And what this legislation does is remove that penalty if it is a qualifying distribution. And the person still has the income tax consequences. It's still includable in income, but they avoid the penalty. Now, with respect to the income they have to report, the legislation allows the taxpayer to report that income ratably over a 3-year period, which of course eases the burden of that additional tax. Then amounts can be withdrawn, or amounts withdrawn can be recontributed into either the same retirement plan or IRA from which it was withdrawn, or can be put back into a different one within a 3-year period. And if the taxpayer does that, it is effectively treated as a tax-free rollover, which gives us a rather strange result. The person may withdraw the money, begin reporting the income ratably over 3 years, and then 3 years later, put the money back into a retirement account, at which point it becomes a tax-free rollover. So presumably, we would have to file an amended return for the earlier years in which the income was reported to get a refund of the taxes that were paid. Now, a third provision that is part of this legislation that applies to federally declared disaster areas is a provision addressing the deduction of casualty losses in federally declared disaster areas. This is on page 9 in the outline, and it is item 4 on page 9. What we find in item 4 on page 9 is that Congress has, in a sense, relaxed the usual rules about deducting casualty losses. Now, first of all, recall in the Tax Cuts and Jobs Act, Congress made most casualty losses non-deductible, personal casualty losses. The only ones that are in federally declared disaster areas, beginning in 2018. But now we have some relaxed rules about casualty losses, and normally a casualty loss is deductible only to the extent it exceeds $100, and then only to the extent that it exceeds 10% of adjusted gross income. What the legislation does is it actually increases that $100 threshold to $500, but then it removes the 10% of adjusted gross income threshold. So if a taxpayer, say, were to incur a casualty loss of $50,000, then then 500 of that is non-deductible, but the remaining 49,500 is. There's no 10% of AGI threshold. Also, this deduction is allowable regardless of whether the person itemizes their deductions. So if it's somebody claiming the standard deduction, and of course many more people are now as a result of the increased standard deduction of the Tax Cuts and Jobs Act, we simply increase the standard deduction by the amount of that casualty loss. These provisions, again, were part of the legislation that applied to Hurricane Harvey. Congress has now extended them to other federally declared disasters, and they are very significant to those affected. Here at the law school, I direct our low-income taxpayer clinic, and we have seen a lot of taxpayers with casualty losses in the past few years. We're still dealing with some Hurricane Harvey-related issues. Now, a fourth provision in this legislation related to federally declared disasters is on page 10. It is item 5 on page 10. And specifically, this is a provision that allows those in federally declared disaster areas to use prior year earned income for purposes of calculating both the earned income tax credit and the child tax credit. So the idea is that if a person was, say, put out of work as a result of the federally declared disaster, maybe they had to move, maybe their employer closed or was inoperable, so their earned income was lower in the current year, they can go ahead and use their prior year earned income in calculating these two credits. The a fifth, actually, I'm sorry, let's losing count here. We are now on the fourth change Congress made. This is on page 19 in the outlines, item 1. And on page 19, item 1, we see that Congress has made it easier to deduct charitable contributions that are directed at relief efforts in federally declared disaster areas. It has to be a contribution in cash to a recognized charity and specifically designated for relief efforts in the disaster area. And in that case, the taxpayer, instead of being subject to a limit of 50% of adjusted gross income, the normal limit for individuals, they can deduct up to 100% of adjusted gross income in charitable contribution deductions. Now, finally, on page 21 of the outline, item 1, we have Congress enacting a 60-day mandatory extension of certain deadlines for those affected by federally declared disasters. That would include those who live there. It would also include, for example, relief workers and first responders who go into that area. And this would be for things like filing deadlines for returns, payment deadlines, and so forth. The Secretary of the Treasury has long had authority to extend these deadlines, and as we know, the IRS routinely does that in response to federally declared disaster areas. But now we have a statutory provision mandating a 60-day extension. The Secretary still has discretion with respect to extending deadlines. So presumably, the IRS could extend these deadlines beyond 60 days. But Congress apparently felt it necessary to designate a minimum 60-day extension. So those are the federally declared or the provisions relating to federally declared disaster areas. Now, let's go on in the outline and talk about the some provisions in the Consolidated Appropriations Act that retroactively extend some deductions and credits. Now, one thing we should recognize about this legislation is it combines what were formerly a number of separate pieces of legislation. So one part of it is the Taxpayer Certainty and Disaster Tax Relief Act of 2019. Some of those provisions we've just discussed. Other portions of the act deal with retirement security, and those are known as the Secure Act. but they're all folded into this Consolidated Appropriations Act. Now, the first item in the area of retroactive extension of deductions and credits is on page 2 of the outline. It's item 1, item D1, which is a retroactive extension of the deduction allowed by Section 179 Cap D for the cost of energy efficient commercial building property. And generally, as I've indicated here on the slide, these are for improvements to that reduce energy and power costs. So things like interior lighting systems, heating, cooling, and ventilation systems, hot water systems, etc. And if they reduce the energy and power costs of that property by 50% or more compared to specified standards, then the person is eligible for this deduction. This was a credit that had expired after 2017, and now it is available for property placed in service through 2020. Now, second item in this area is item E1 on page 3, and this is a provision that's fairly narrow, but I thought I'd mention it at least. This is a specifying a 3-year recovery period for racehorses. So if you have racehorses and we're wondering what your recovery period is, it is in fact 3 years. Now this special provision had expired after 2017. Congress has now extended that to horses placed in service through 2020, through this year. Also on page 3, we have item 2, which is a 7-year recovery period for motorsports entertainment complexes. Again, this had expired after 2017, and this now applies to property placed in service through 2020. Now, let's move forward in the outline to some further deduction and credit items that Congress has either retroactively resurrected or has enacted for the first time going forward. And the first of these is, again, on page 3 of the outline. It's item F1. And this is a 3-year credit for small employers that implement an automatic contribution arrangement in their retirement plan. This is new section, code section 45, capital T. The maximum credit for this is $500. So it's not an overly generous credit. That's not per employee, that's per taxpayer. And generally, an automatic contribution arrangement is when the employer allows an employee, or let's put it this way, it's when the employer specifies that the employer will automatically deduct elective deferrals from the employee's wages unless the employee elects out, unless they elect not to make a contribution at all or to reduce the amount of their contribution. And the goal of these sorts of programs where the employee has to elect out is to increase the proportion of people saving for retirement, because if people have to elect out, they are less likely to do that as opposed to getting people to elect in, which results in fewer people saving for retirement. So if an employer implements this or eligible for this new credit, this would apply not only to new plans, but to existing retirement plans. So if this feature is added, the employer becomes eligible for the credit. Also, on page 3, item F2, we have in the area of credits, the credit authorized by section 45, capital L. And this credit is in the amount of either $2,000 or $1,000. It's available to contractors who are building energy efficient homes for sales to customers. And this credit had expired after 2017, and now this applies to homes that are acquired through 2020. Then we have Congress extending a credit through 2020 And this is a credit, and I did not indicate the page number here on the slide, but it's that same page, page 3. It is item F3 on page 3. And item F3, page 3, summarizes this credit. It's a credit that's available to employers that pay wages to employees during periods of family or medical leave. Now, to be eligible, the employer has to pay a minimum amount of or percentage of normal wages to the employee, and that level is 50%. And if the employer is paying at least 50% to the employee during the employee's period of family or medical leave, then the employer gets a credit of 12.5% of the wages paid. Now, the amount or the percentage of the credit goes up to the extent the employer is paying more than 50% of the wages. So if the employer pays 100% of wages during the period of family or medical leave, the amount of the credit goes up to 25% of wages. So the credit is therefore going to range between 12.5% and 25%, depending on the percentage of normal wages being paid by the employer. Now, from here, let us go to page 5 in the outline, page 5. And on page 5, this is item 2, we have, just one second here, I'm seeing if I can adjust something. There we go. All right, on page 5, item 2, we have Congress changing the age at which required minimum distributions must begin. And so item 2, item B2 at the bottom of page 5 tells us that Congress has increased the age at which required minimum distributions must begin from 70.5 to 72. And what that means then is that required minimum distributions now have to begin by April 1st of the calendar year following the year in which the taxpayer attains age 72. So the later of April 1 of the year, calendar year, following the later of the year in which the taxpayer turns 72, or if it's an employer plan, the calendar year in which the employee retires. So generally, RMDs have to begin by the later of those two periods. So April 1 of the later of the year the person attains age 72, or the year in which they retire. Recall that that later of rule, allowing you to retire at a later age, does not apply to 5% owners as defined. That's defined in section 416. Now, that's in the case of an employer plan. What it means for an IRA is that we have only age 72. And so now our required minimum distributions have to begin by April 1 following the year in which the person attains age 72. Now, this is going to apply to distributions required to be made after 2019 for individuals who attained age 70.5 after that date. So if you became age 70.5 on December 31 of 2019, sorry, your distributions have to begin by the upcoming April 1st. On the other hand, if you turn 70.5 on January 1 or forward, you're now subject to the new rule, was you've got until age 72 to begin taking those out. Now, from here, let us go to item 6, item B6 on page 3. Now, let me make sure I'm in the right place here. This is not this is actually page 6. Sorry about that. I think I've reversed those two. So should be item B3 on page 6. And item 3, page 6 in the outline, is a summary of Congress's change in the Consolidated Appropriations Act in the rules on when the money has to come out of an inherited retirement account for those inheriting who are not a surviving spouse. So if we have somebody now inheriting a retirement account, could be a qualified plan, employer plan, could be an IRA, and the person inheriting is not a spouse, now we've got a new rule. Now, formerly, the way it worked was the person inheriting the account could take required minimum distributions over a long period of time, generally that person's lifetime. Congress has changed that significantly. And so now, if we have an inherited retirement account, both defined contribution plans and IRAs, all funds in the account must be distributed by the end of the 10th calendar year following the year of death. Now, there's no longer a requirement that amounts be withdrawn before that date. So we don't have to begin and take them out over 10 years. They just have to all come out during that 10-year period. So it seems we could wait until the end of the 10 years, and as long as we withdraw all of them by that point, we're fine, and we avoid the penalty for not doing that, and that's generally is a very significant penalty. Now, the current rules, the rules that permit taking distributions from an inherited retirement account over a long period of time, continue to apply to certain categories of people. And specifically, as I've indicated here on the slide, surviving spouses are still eligible for the old rules. Children of the participant who have not reached the age of majority at the time of the participant's death, and those who are not more than 10 years younger than the deceased individual are still subject to the old rules. Now, this is going to apply to distributions with respect to those who die after 2019. So again, if we have somebody who died at the end of 2019, they still get the benefit of the old rules. From 2020 and forward, those inheriting have to pull the money out within 10 years unless they fall into one of these categories. All right. From here, let's go over to item 4. And I apologize. It looks like I've reversed the item. So this is item B4 on page 6, not item B6, page 4. It's item B4, page 6 of the outline. And item B4 is a provision from the legislation. This is part of the Secure Act, which was, again, folded into the Consolidated Appropriations Act, that permits penalty-free withdrawals from an applicable eligible retirement plan for what they term a qualified birth or adoption distribution. Now, what is that? It's defined, and as I've indicated here, it's any distribution from a retirement plan to be made to an individual during the 1-year period beginning on the date on which the child of the individual is born or on which the legal adoption by the individual is finalized. So we look at the date of birth or the date the adoption is finalized. We look forward 1 year, and distributions taken during that time are not subject to the normal 10% penalty of Section 72T. Now, the withdrawals are still includable in income, say if it's taken from an employer plan or from an IRA, a traditional IRA, but the 10% penalty does not apply. Now, notice there does not seem to be a tracing requirement. There doesn't seem to be a need to show that you spent the money you withdrew on child-related expenses, but merely that you took it out during the 1-year period following the birth or adoption. There are some reporting requirements, and so to get the benefit of this exception to the penalty, the taxpayer is going to have to include the child's name, age, and taxpayer identification number on the return, which may prove problematic if we have somebody who has a child or adopts a child toward the end of the year. It may take a little time to get the Social Security number. Now, the maximum penalty-free withdrawal is $5,000 per individual per birth or adoption. Now, one question that's come up as I've spoken with people about this provision is, what about someone who has or who adopts multiple children? So let's say a woman who gives birth to twins. Do we have the ability to withdraw $5,000 penalty-free, or is it $10,000 penalty-free? And on that note, I thought I'd share a discussion I had with a small group here in Houston where we discussed this provision. And one of the members of the group was sitting next to me, a woman who had twins, and her response to that question was, believe me, it was 2 births. If you get 2, you get 2 of these. So the ability to deduct, to withdraw $10,000 without the penalty. And I think that's the right result. So if you have twins, that seems to be 2 births. And if you adopt 2 children, those are really 2 separate legal adoptions. And so my take on that is you get to withdraw $5,000 for each of those penalty-free. This applies to distributions after 2019. Now, let's go on to page 8 in the outline. Page 8. This is item D1 on page 8. And again, this is a provision from the Secure Act, part of the Consolidated Appropriations Act. And here in item D1, we see that Congress has amended section 219F1 of the code. And this provision now provides that amounts that are paid to an individual as they pursue graduate or postdoctoral study that are included in their income are treated as compensation for purposes of the limit on contributing to an IRA. So recall, the limit on contributing to an IRA is around $6,000, I believe, for the current year. However, your deductible contribution to an IRA can never exceed the amount of your compensation. So you have to have compensation of at least $6,000 to be able to contribute that amount. Now, what this legislation then does is it characterizes items of income received by a graduate student in connection with their postgraduate study, with their graduate study, as compensation that would then support a deductible contribution to an IRA. So this would apply to things like stipends received by a graduate student or fellowship payments that are paid to that person. And again, this will apply to taxable years beginning after 2019. So will not apply for those dealing with the current filing season for 2019, but will apply for 2020. All right, and again, if you have questions as we're going along, I'd encourage you to ask those. All right, let's go to item 2 on page 8, the same page. And item 2, page 8, summarizes Congress's amendment of the rules on contributing to a traditional IRA. So the age limit on contributing to a traditional IRA was formerly 70.5, and Congress has now eliminated that entirely. They have simply repealed section 219D1 of the code. And so what that means is that somebody who is 70.5 or 80 or 95 can now make deductible contributions to an IRA. Now, there is a connection in the legislation between this and the ability to withdraw amounts tax-free from an IRA for those aged 70.5 and older to give to charity. So recall that for some time now, taxpayers have had the ability, those who are age 70 and a half and older to withdraw money tax-free from an IRA as long as it's given to charity, and they could withdraw up to $100,000 tax-free from the IRA for that purpose. And of course, the ability to withdraw it tax-free and give it to charity is the equivalent of withdrawing it and having income and getting 100% deduction for it. So what Congress did in this legislation is to say that a taxpayer's $100,000 limit on the amount they can withdraw to give to charity, so the limit, the $100,000 limit on the amount they can withdraw tax-free to give to charity is reduced by the amount of deductible IRA contributions that they make after age 70 and a half. Now, the legislation is not entirely clear on this as to how this limit applies. One reading is that you'd apply this on an aggregate basis. So if a taxpayer withdraws, let's say the taxpayer contributes $6,000 at age 72 and another $6,000 at age 73 and deducts that, that's now $12,000 of contribution. Do we reduce their $100,000 limit in that second year by $12,000 or by $6,000? My own reading is that we do this on a year-by-year basis. So if in year one, after age 70 and a half, the taxpayer contributes $6,000, their limit on withdrawing for charity that year is $94. And then when we get to year two, if they contribute another $6,000, their limit on withdrawing tax-free for charity in year two is again $94. So it appears to me to apply on a year-by-year basis. These rules, so the removal of the age limit on contributing to a traditional IRA applies to contributions to an IRA and distributions from an IRA for charity that are made for taxable years beginning after 2019. So these rules are not in effect for 2019, but they are in effect for 2020 and forward. Now, let's go to item B1. Item B1 at the bottom of page 8. And here we see Congress in the legislation extending retroactively certain provisions. And specifically, the first of these is the exclusion from gross income for cancellation of qualified principal residence indebtedness. Now, recall that generally, discharge or cancellation of indebtedness is gross income for the taxpayer, but there are exclusion provisions, such as if the taxpayer is insolvent or in bankruptcy, and this was one of them. If the debt that was canceled was qualified principal residence indebtedness, and that's a defined term. It generally is acquisition indebtedness within the meaning of the rules for deducting mortgage interest. So that means debt that the person incurred to acquire, construct, or substantially improve a qualified residence of the taxpayer. Now, specifically, it had to be debt that the person incurs to acquire, construct, or substantially improve their principal residence to get the benefit of this exclusion, and there's a limit on the amount excludable of $2 million. Now, this provision had expired after 2017, so it was not in effect for 2018, not in effect for 2019, and now Congress has retroactively extended this, so it applies now for 2018, 19, and also 2020. Now, what this means is that if a taxpayer in 2018 had a cancellation of qualified principal residence indebtedness, they may want to amend their return to go back and exclude that and generate a refund. One consequence of the exclusion, recall, is if you take advantage of it, the taxpayer does have to reduce his or her basis in the house by the amount excluded under this provision. Now, on page 9 page 9, item 1, we have a summary of Congress's extension of a lower threshold for deducting medical expenses. And for many years, the taxpayer could deduct medical expenses as an itemized deduction on Schedule A, only to the extent that the medical expenses exceeded 10% of adjusted gross income. Congress then reduced that threshold to 7.5% for those aged 65 and older by the close of the year for 2012 through 2017. And then in the Tax Cuts and Jobs Act, Congress extended that 7.5% threshold to everybody for calendar years 2017 and 2018. But it was not in effect for 2019. So what this means is that according to this legislation, the reduced 7.5% threshold applies for 2019 and 2020. So medical expenses are deductible in those years to the extent they exceed 7.5% of adjusted gross income. Now, also on page 9, item 2, we see that Congress has again retroactively extended the favorable treatment of mortgage insurance premiums. Now, specifically, the way this works is a taxpayer was permitted under the rule as it existed to treat mortgage insurance premiums the same as interest paid on the home mortgage loan, to treat it as qualified residence interest and therefore deductible on Schedule A as an itemized deduction. This provision again had expired after 2017, so it was not in effect for 2018, and therefore for 2018 and 19, it was not in effect. Congress has retroactively restored that for 2018, 19, and also 2020. So again, for 2018 returns, the taxpayer may want to amend in order to take advantage of this deduction, which is now available. Now, item 3 on page 9 is Congress's restoration again of a deduction that was available under Section 222 of the Code. And this was a deduction, an above-the-line deduction, for qualified tuition and related expenses paid for the taxpayer's spouse or dependents. And the credit was either $2,000 or $4,000, depending on the taxpayer's level of adjusted gross income, and it could get phased out entirely as adjusted gross income got too high and becomes zero. Again, this provision had expired after 2017, and Congress has now retroactively restored it for 2018 and 19, and also for 2020. So again, if somebody filed in 2018, it's possible they'd want to amend to take advantage of this. Recall that if we have qualified tuition and related expenses, that the taxpayer has the option to take a credit for that under Section 25 Cap A. That would be either the American Opportunity Credit, formerly known as the HOPE Credit, or the Lifetime Learning Credit. Generally, my experience is taxpayers are better off with the credit than with this deduction, but this is available as an option to take an above-the-line deduction up to these amounts. Now, on page 11 in the outline, page 11, item 1, we move into the area of education. So we've been in the area of personal income and deductions for a while, and this continues in that area. So Congress has amended the rules for Section 529 accounts. And recall, these are accounts that are typically used to save for education. So a typical usage would be parents saving for their children's college education. Also recall, in the Tax Cuts and Jobs Act that of 2017, Congress expanded the permissible uses of Section 529 funds. So maybe we should start with how 529 accounts work. That is, taxpayers contribute to the account to save for the cost of education. Contributions are not deductible, but the amounts there build up on a tax-deferred basis. And if the amounts are withdrawn to use for qualifying educational expenses, they can be withdrawn tax-free. Well, Congress in the 2017 Tax Cuts and Jobs Act amended these rules to permit withdrawal tax-free of funds from 529 accounts to pay for the cost of education at private or religious schools for K through 12 education. So say parents sending their children to private schools can withdraw from 529 accounts to pay for that. There were two changes Congress made in this legislation. One was now we can withdraw tax-free from a Section 529 account to pay expenses for fees, books, supplies, and equipment required by the designated beneficiary for participation in an apprenticeship program that is registered under the National Apprenticeship Act. I think the more significant change, which will affect more people, is the second one, which is that now we can withdraw up to $10,000 aggregate, that is lifetime, up to $10,000 tax-free from a Section 529 account to pay principal or interest on any qualified higher education loan of either the designated beneficiary of that account or a sibling of the designated beneficiary. So now we can withdraw tax-free from the 529 accounts to pay student loans of the designated beneficiary of that account or loans of that person's sibling. Now, this $10,000 aggregate limit applies separately to the designated beneficiary and to the sibling. So if we withdraw to pay the siblings educational loans, that is not going to count against the designated beneficiary's $10,000 limit. Now, there is a connection here between the ability to withdraw tax-free to pay educational loans and the ability to deduct interest on educational loans. Recall that Section 221 of the Code provides an above-the-line deduction for student loan interest. And if a taxpayer is now using tax-free money to pay the student loan interest, that interest becomes non-deductible. So in essence, we have to determine whether in that year the taxpayer has both withdrawn tax-free to pay the loans and then paid the loans as well. And if so, the interest deduction under Section 221 is going to get reduced to the extent tax-free money is being used for that. Now, this applies to distributions occurring after 2018. So this is not a typo. That is this. So it seems to apply to distributions that occurred, say, in 2019. Now, let's go from here over to item G1 on page 11. And on item G1, we have a summary of a notice from March of 2019. That is notice 2019-20, which we've discussed previously in the First Wednesday Tax Update webcast. However, there have been some recent developments, and so I thought we'd return to it today. The way to understand all of this is to recall that when the instructions for Form 1065, the partnership tax return, and also Schedule K1, which is issued to partners, when those instructions were issued for the 2018 year, they had a new requirement, and that was that if a partner's tax basis capital account is positive or negative at either the is negative. If it's negative at either the beginning or end of the year, and if the partnership is not reporting tax basis capital accounts, then it must report the amount of the negative tax capital account on Schedule K1 on line 20 with a specific code. So that caught many people by surprise. And again, the rule was if the partnership is not reporting tax capital accounts and a partner's tax capital account at the beginning or end of the year is negative, then the partnership had to report on Schedule K1 to the partner the amount of the negative tax capital account, and of course that also gets filed with the IRS. Now, notice 2019-20 provided some relief to partnerships that had failed to report appropriately in accordance with that new instruction, and enabled ships to take some corrective action if in fact they had not done it correctly. So if you work in this area and you haven't yet taken a look at this, you'll want to take a look at that. There is an upcoming deadline in connection with that corrective action. Now, the more recent developments are on page 13 of the outline. And on page 13, we see that the IRS issued a draft of the Form 1065 and Schedule K1 for 2019. And the draft of those forms required partnerships to report tax basis capital accounts on the Schedule K1. And this was a departure because previously the Schedule K1 had permitted reporting tax capital accounts on a book basis, say a GAAP basis, or some other basis, or tax basis capital accounts. But now that ability is gone, according to the draft instructions that came out. So you now have to report tax basis capital accounts. That was a huge change because many partnerships do not track tax capital accounts, and that meant that they would have to go back and reconstruct them over many years. So there's a fair amount of work involved in that. There were several other significant changes in the draft Form 1065 and Schedule K1, which are summarized in this write-up beginning on page 13 and continuing on to page 14. So you can see the changes there. What I want to emphasize, though, is this last item on this slide, which is that the IRS has issued Notice 2019-66, issued that in December of 2019, and that defers until partnership tax years beginning after 2019 the requirement to use tax basis capital accounts. So that's item C on page 14 of the outline. So what that means then is for the 2019 year, the partnership can report the same way it reported for 2018, using, say, book capital accounts or tax capital accounts or GAAP, subject to that requirement that if a partner's tax capital account is negative at the beginning or end of the year, and if the partnership is not reporting tax capital accounts, it must report that on line 20 of the K1 using that code. So, but the requirement to go back and reconstruct tax capital accounts for everybody has been deferred. Now, from here, let's go into the area of exempt organizations for a minute. And specifically, this is on page 18 in the outlines. Page 18, item D. Page 18, item D, summarizes Congress's repeal of an increase to unrelated business taxable income. This was a change in the Tax Cuts and Jobs Act that we've discussed previously in the First Wednesday Tax Update. And specifically, what Congress did in the Tax Cuts and Jobs Act is for taxable employers, it disallowed deductions for qualified transportation fringe benefits, say qualified parking, transit passes, transportation in a commuter highway vehicle. And as a companion provision, Congress enacted a rule saying that if a tax-exempt organization is providing those benefits to employees, it must increase its unrelated business taxable income by the non-deductible portion of those benefits. That created a real mess for exempt organizations and would have caused exempt organizations that had never had unrelated business taxable income to have it for the first time and to have to report on the appropriate form to the IRS and pay tax. So Congress has now, in this legislation, retroactively repealed that provision, Section 512A(7). So exempt organizations are no longer subject to that requirement. Now, this repeal is effective as if the provision had never been enacted, which means that there may be exempt organizations who paid unrelated business income tax in 2018, and presumably they would be entitled to a refund for those amounts. All right. Now, on from here, let us go forward to, I think I'm going to, let's go to page 20 in the outlines. Page 20, item 1. And page 20, item 1 is page 20, item 1 is a summary of a case, the Keston case from the tax court. And that is a case that was from August of last year, but it's not appeared in the outline previously, so I thought I'd mention it briefly. It deals, this is in the tax procedure area, and it deals with the penalties for filing a frivolous tax return, which is $5,000 per frivolous tax return. This was a taxpayer who filed so she reported her wages correctly. She filed an amended return, taking the position that the wages were not taxable, and therefore was seeking a refund on the amended return. And the IRS then responded, gave her an opportunity to change her position on the amended return. And in response, she made 6 photocopies of the amended return and sent them all in to the IRS. And the IRS imposed not one $5,000 penalty for a frivolous tax return, but 7 penalties, 1 for the original return and 6 for the photocopies. And in this case, the tax court reviews what is considered a return for this purpose, and generally what is considered a return, and concluded that those photocopies of the return were not a return, and so did not give rise to a frivolous filing penalty. Now, as our last 2 items, let's go to page 23 of the outline. Page 23, item 1, C1, and item 2. And there we see that in the legislation enacted in December, that Congress has repealed 2 taxes that have been somewhat controversial for years. They are the Cadillac tax, so-called, of Section 4980I, and also the medical device tax. That's a 2.3% tax on medical devices sold, imposed by Section 4191. The Cadillac tax, as it's so-called, is was a 40% excise tax imposed on certain group health plans that had generous benefits. And Congress, with respect to both of these, either suspended their application for periods of time or declared a moratorium on them. And now finally in this legislation, they have simply repealed them. And the repeal of both of them is effective for taxable years beginning after December 31, 2019. Now, those are the last items that we will talk about today. I want to thank you very much for joining me. I hope that you found these items helpful, and I hope that you'll join me next month for the First Wednesday Tax Update. Thanks very much.